Hi, welcome to the first quarter 2013 economic update. My name is Jeff Hyback. I'm the portfolio manager for strategic equity management. Today we're going to continue our series in looking at the economic picture and how it relates to congressional and Federal Reserve policies. The thing we want to do first today is talk about the leading indicators. These are indicators that helped us in 2007 begin warning our clients and our other advisors that worked with us about the upcoming recession. They've also helped us to avoid calling a recession when so many other advisors started doing that, both in 2010 and a few times in 2011. So let's dig right in. The first economic indicator, and this always kind of baffles people, is the stock market, because we're trying to use economic numbers to analyze what we think is going to happen in the stock market. But the market is a good leading indicator because it shows what everybody believes is going to happen with future earnings. And bottom line, at the end of the day, the stock market is just the consensus view of what everybody believes the earnings for the S&P 500 companies in this case is really worth and what people are willing to pay for it. And as you can see, if you look at that chart, the market is once again approaching the highs it hit in March of 2000 and again in October 2007. Right now, that is one of the stronger economic indicators out there, is the growth of the market. As long as the market's going up, most people believe the economy is going to be getting stronger. But as you look a little bit deeper into the economy, there's a few things that are looking very strong that we need to focus on, because if these indicators get weak, it's likely that the stock market is going to decline in value. So what I've been telling people for at least the last 12 months is that we need to focus on building permits and housing starts, because that is something that gives us a sign that the economy is doing better. And what I like to look at is the level of growth that starts coming out of these economic indicators. If you think about when a new home is built, not only do you have people working on that home, but you have the materials, you have everything that needs to go into that house, as well as the economic activity that takes place after somebody moves into a new house. So what I'm looking at here is some very strong growth. We've seen 20 to 35% growth year over year in building permits. So that means we're seeing 20 to 40% more activity taking place in the economy, and that's more stimulus that's going into the economy that should help get things going. And what I want to see is the number of permits continuing to go up as well. A lot of people say, well, there's no way we can keep up with the pace. But if you look at this chart here, you can see that building permits are just now getting back to levels that they were at in the 1990s. We have a long way to go. We could double where we're at and just kind of be back to where we're at the end of the 2002 recession. So there's a lot of room for growth. And in fact, something that I've begun to notice during the housing bubble in 2007, we were pointing out this chart, and you can kind of see the bubble there where it gets above the long-term trend. Now you can see we're actually below the trend line when it comes to building permits. So that's something that could continue to add to economic growth. Another thing that I think is a key indicator for our economy is the manufacturers' new orders. Now you can see this thing has been a little bit volatile, but any number above 50 is a good sign for the economy, because that means that people are confident enough to place orders for the future. And as you can see, it's beginning to rise again, pointing to some stronger growth. Another thing that I really got excited about when we saw the last jobs report is the number of hours has begun to increase. Now the reason this is important is because employers, before employers really want to start adding jobs, you're going to see them start to increase the number of hours worked. You might see overtime added. You might just see people go from 30 hours to 40 hours a week. So this is a key indicator of future employment growth. However, we aren't seeing strong enough growth yet in jobs yet. But as you can see, jobs are gradually coming back. And you can see the nice boost that we saw in February coming off of a lackluster January. So we are starting to see some stronger gains again in the jobs market. The problem, though, we're seeing is that GDP growth has not really kept up. We've seen just a few indicators adding to growth. And that's something that is really starting to baffle people. And you could see that since the last recession, we've only had 2 quarters grow over that long-term average of 3.1%. And that's despite a whole bunch of stimulus. I think the last count was $13 trillion between the government deficit spending as well as the money the Federal Reserve has electronically created. So in general, this is where we're at as far as strategic equities leading economic indicators go. We have a few that are above trend growth. Trend growth is 3.1% or higher, and these are the indicators pointing to stronger than average growth. You have building permits, as we already talked about. You have manufacturers' new orders, and that's it. So you have 2 that are showing above trend growth. At trend growth, which is 2 3/4 to 3% growth for 2013, we have hours worked. We already talked about that. You have payrolls that are gradually starting to increase, and stock prices. And we also didn't look at this indicator, but we see service business activity also is picking up growth. Now, that kind of puts us right in the middle. You could see stock prices are anticipating about 2 3/4 to 3% growth, and we only have 2 that are predicting stronger growth. We have a few, though, that are below trend, and this is something that could start to be a concern for the economy. You have vendor performance, and that's what that's looking at is how quickly are people paying their bills when they place a new order. You also have capacity utilization, and that's showing how much of the capacity, total capacity that a manufacturer has that they're actually using. And we also didn't talk about it yet, but consumer confidence has been declining, and so with that decline, you're starting to see that maybe it's indicating below average growth. Again, any of these indicators could be a concern for the economy, because if you don't see strong growth in vendor performance, capacity utilization, and consumer confidence enough to overcome the strength we see in building permits and new orders, then stock prices are probably going to have to correct. In general, if you forget everything that's happening in Congress and you just look at these indicators, you can see that the overall indication for growth is 2.7 to about 2.9% GDP growth. This is a slight improvement from our last update at the end of December, and we've started to see that things like retail sales have been stronger than people expected. Consumer spending's been a little bit stronger than people expected. So we are seeing that thus far the consumer has been able to overcome some of the fiscal cliff items that were kind of holding it back. Now the question is, when are we going to see above average growth? We've seen at trend growth, or what I call lackluster GDP growth, for quite some time, but the market is pricing in average to above average growth. And what I want to focus on is what we call an expansion chart. And these are put together by the Federal Reserve, and it looks at where we're at now versus the best and the worst, as well as the average economic recovery. And you could see in terms of GDP growth, we're now tracking the worst recovery on record of GDP. And so you look at stock prices, and here they are back to almost at the all-time highs, and yet GDP is tracking the worst recovery. So something doesn't add up there. Something is disconnected. Either the S&P 500 is predicting some very strong growth that's going to get us back way above trend, or S&P is not reflecting reality, and it's going to have to reflect what the real value of the market really is when things catch up. And we'll talk about what the catalyst has been in here in a minute. You also look at personal spending, consumer spending. It's also tracking the worst recovery on record. So consumer spending has not picked up, and it's real easy to see why. If you look at job growth here, job growth is right along the bottom of the worst recovery on record, and even worse, when you look at disposable personal income, you can see that little blip up at the end of 2012, and that was because a lot of companies paid special dividends trying to get ahead of the fiscal cliff items that were coming up. But now you can see personal income fell back down, and again we continue to track the worst recovery on record. So no wonder consumers don't feel very confident right now. No wonder so many people feel like we're not even out of the recession. When you talk about a recovery to most consumers, they say, what recovery? I feel like we're still in a recession. Well, this is a key indicator why. Now, something else that I really want to look at is we see that so many people in Congress are saying we need to keep spending money. And what I asked them is, how much more stimulus will it really take? This number here shows the federal surplus or deficit, and as you can see, most of the time we've been running a deficit. And I put this chart up there to kind of put in perspective how low how big the deficit has gotten. And you can see the improvement. We're still running $1 trillion deficit. And so we go back to what GDP growth was showing and how lackluster it's been, and yet you have people saying we need to spend even more money. The question becomes, how much more stimulus are we really going to take when it comes to that? When you just look at the level of debt, because if you think about it, if we're spending more than we're taking in, we have to borrow money. And you can see this number here. We ended the 2002 recession at $6 trillion of total public debt. Well, unfortunately, during that economic recovery, we didn't pay back any of the money that we borrowed to fight the last recession. So then when we entered this recession, we had just a little bit over $9 trillion of debt. Well, we're over $16 trillion now. So we spent $7 trillion just since 2008 to try to fight this recession. And then you have people saying we need to spend more money. So the question becomes, how much will it really take? What are we paying for? You're looking at lackluster jobs growth, lackluster economic growth, personal income is well below where it should be, and yet the market is sitting at all-time highs. So do we need to spend more? Do we need another $7 trillion of debt? Eventually that money has to be paid back. The other thing, when you look at what the Federal Reserve is doing, they've kept interest rates very low. They've done quantitative easings all over the place. They've had Operation Twist. They've had some other operations that they've done. And what we've noticed, though, is the money the Fed is creating is not going into the economy. It's sitting. If you look at the red line and the way it tracks the blue line is what the Federal Reserve is doing as far as asset growth on their own balance sheet. That's new money they're creating. And the red line is what I call the savings account the banks have at the Federal Reserve. And you can see, it's basically tracking. If the Federal Reserve slows the growth of its balance sheet, you see that the growth of assets held at the Fed tends to slow down. What's happening here is the Treasury Department has to borrow money. We all know that. So they go to the market and they sell Treasury bonds. And the Wall Street banks are buying these bonds knowing that in the next few days the Federal Reserve is going to create more money, turn around and buy them back at a profit to the banks. And then they can just turn around and they can leverage that money and invest it somewhere else, or they can just book the profits. And people point to the S&P 500 and say, look, we're having record profits. Well, the reason we're having record profits is 47% of the earnings growth has come from financial companies. Another 20% of the growth has come from technology companies, where more than 100% of technology earnings growth has come from Apple. And that's because companies like Dell and HP and Microsoft and IBM have all booked some very big losses since 2009. And those have been offset by the growth of Apple earnings. So you're looking at close to 70% of the growth came from the Federal Reserve's money printing and Apple Computer. Well, we've seen what's been happening to Apple stock lately. It looks like their growth is slowing down. And the question becomes, with the Fed creating over $3 trillion of new money, basically becoming the primary buyer of Treasury bonds, the primary supplier of funding for the U.S. government, what's going to happen not only if the Fed stops doing that, but what's going to happen if they have to start selling their assets on the book? What happens if interest rates start creeping up because maybe we are seeing strong growth and inflation starts to pick up? Well, the Fed's been supporting the market via giving the money to the banks and helping them book record profits, that if we don't see extremely strong growth somewhere else, enough to not spark inflation, you kind of see the rock in the hard place that the Federal Reserve is sitting in right now. Now, where does that put us as portfolio managers? Right now, we're enjoying this quantitative easing 3 and 4 induced party. If the Fed wants to keep printing money and it's not being fought by the free market, we say more power to them. We're active money managers, so we're riding this thing out right now. But what we know, there's a very smart hedge fund manager named Stanley Druckenmiller. He actually managed money for George Soros. George Soros hired him to manage his own money. So this tells you he's one of the best money managers out there. And in fact, he beat the S&P 500 pretty much every year of his career. Well, he started talking about how the retirees, the current generation of retirees, is robbing their children and grandchildren. And what that means is, because they're borrowing so much money to try to support the market and their retirements and everything else, that's going to have to be paid back at some point. Congress is not even addressing Social Security and Medicare. We're looking at close to $100 trillion in liabilities on top of the $16 trillion that we're discussing right now with the debt ceiling. That money has to be paid back somehow, either by less spending, higher taxes, or most likely both. That's all anti-growth. And where is the growth of the S&P 500 earnings going to come into the future if we're having to pay back all this money we're borrowing now? And I had to laugh because Jim Cramer of CNBC, when Mr. Druckenmiller came out with this statement, said, look, we all know this is going to end badly, but in the meanwhile, we can make some money. Well, that's exactly what we're trying to do at Strategic Equity Management. We are trying to be active right now. We want to be in the market, but we've been doing this for over 20 years, and we know that when it does end badly, when you need the defense to take the field, we're going to be there. So even though the economy is looking pretty strong right now, strong being a relative word, it's not going into recession yet. We are going to see about trend growth somewhere in the 3% range in 2013. So the market's not going to start panicking yet. But when that money has to start being paid back, when the free market takes over and maybe starts raising interest rates, then what happens? That's what we're here for. Now, we've covered a lot of information today in a very short period of time. I write a daily blog that I post on our website, stratequity.com, and you can register for that website by either registering as an investor or a professional. And once you do that and confirm that you are a real person, you'll just have to get one email. That's the last email you'll see come from us regarding your registration. Then you can click on that trading desk update that you see there at the bottom of the page. And I'll post my thoughts on the market. I'll also post how our portfolios are adapting to what's going on in the market. I hope you found this information useful. We will be back for sure at the end of next quarter, sometime in the last few weeks of June, to give our latest economic update. If there's something that develops before then, definitely be checking the Traders blog, as well as look for additional updates. In the meanwhile, my name's Jeff Hyback, Portfolio Manager Strategic Equity, and I hope you have a great rest of the quarter.